A lot of it has to do with that cycle of interest rates. And so, the whole concept of the long-term debt cycle is, so if you look at the short-term debt cycle, right, the 5 to 10 year business cycle, the whole thing that happens there is you get leverage building up in the system, and then some sort of external catalyst comes, or policy error or something like that, and you get a deleveraging event. But then policymakers jump in. They don't want that deleveraging event to take too long. People get angry because it's a recession, so they cut interest rates. They do all sorts of things to try to stop the bleeding and stop that deleveraging. And so what happens is at the end of the cycle, you never fully deleverage compared to the beginning of the cycle, right? So you build up debt, then you decrease it a little bit as a percentage of GDP, but you didn't really get down to where you started. And so when you string multiple of those short-term business cycles together, what you end up getting is higher and higher debt levels and lower interest rates in each cycle, basically higher highs of debt and lower lows of interest rates. And eventually policymakers run into roughly zero interest rates, or in some cases mildly negative interest rates, and they can't really go any lower. And at that point, debt is extremely high and is very reliant on those low interest rates. And so what happens in that event is, what policymakers turn to is essentially a currency devaluation, where they focus on fiscal stimulus, and then whatever inflation comes from that, they still do, they hold interest rates near zero. They do essentially financial repression. So, if you're holding money in a bank account, you're getting paid less than 0.5%, while inflation's running 3, 4, 5%. In some cases more. I mean, the 1940s hit very high levels, and so that basically inflates away part of the debt. But then also, if you are a bondholder or a cash holder, you're also essentially inflating away part of your purchasing power. And so that's really what separates that long-term debt cycle, is that policymakers essentially box themselves into a corner where interest rates are super low, debt's super high, and other than inflating part of that debt away, they don't really have a ton of options for how to get out of that.
You mentioned negative rates. Just want to ask you a question. The reverse repo market has been pretty active lately with the Fed. Do you think they're trying to have some kind of a floor so that rates don't go negative?
That's essentially what they've been doing. Yeah, basically it's kind of the opposite problem of late 2019 repo spike. And so back then, you had too many T-bills compared to the amount of reserves in the system, and so they responded by creating bank reserves to buy T-bills, essentially monetizing U.S. debt. Now here in 2021, what's happening is that they've done so much QE that banks are so full of reserves, that they don't really have anywhere to put it, and they have certain kind of regulations like the SLR, for how much basically deposits they can accept, and how much overall balance sheet capacity they have. And so one of the things they're doing is basically reverse repo is kind of a liquidity sink. Banks are able to put that capital in there, and that stops basically T-bill rates from going negative, and basically is a spillover. And part of that, I mean, it's compounded by the fact that the TGA is being drawn down. So the Treasury General account is going back down from its very high levels of I think it peaked around 1.8 trillion. As that goes down, that money is getting pushed back into reserves, into bank reserves. And so that's also contributing to this excess liquidity. And so for this period of time, that's essentially a liquidity drain. You can think of it as almost the exact opposite scenario of 2 years ago.
Should this the reverse repo market right now, should this be something that we should all be concerned with?
It's certainly something I'm watching, because it could affect policymaker decisions about when they want to taper quantitative easing. They might adjust some of the interest rates on excess reserves. And so overall, they might do some policy tweaks. They're also talking about making some of those facilities more permanent, or broader, like the number of entities that can access those could be broader. And that has implications for long-term liquidity. But overall, it's there's a lot of kind of sensationalist content about that, about how it's going to cause major disruptions. I don't view it in that sense, but it is something I'm watching pretty closely, because it basically is showing that we're kind of at maximum liquidity right now. That any more liquidity just gets sucked right out anyway.
Given that humankind has never printed so much money in history like today, with exponential increases in debt and money supply seen in many of the Fed's charts, and that governments have no viable solution to normalize the situation, are you expecting sort of an economic mega tsunami heading our way soon?
Well, mainly what I'm watching is, kind of a lengthy period of persistently negative real rates. I think that's what policymakers are aiming for. They've even been pretty explicit about their intentions. And so, for example, if you look back for the past decade, T-bills spent most of their time with negative real returns. And I think we're seeing that playing out again here in the 2020s to an even bigger degree, and including a lot of those longer duration types of bonds as well, where if you hold a 5-year or 10-year treasury, by the end of this decade, I think you're going to have less purchasing power from that bond than when you originally bought it. And so I think that's kind of the biggest takeaway of this decade. Now, whether or not we get tsunamis, economic tsunamis, a lot of that partially depends on individual countries' political situations, and so there are kind of these powder kegs around the world. I mean, Europe obviously has an issue, with the way that the euro is constructed between, say, the political disagreements between, say, Germany and Italy, for example, because a lot of them have essentially ceded control of their currency. We also have the United States. You have a very high degree of political polarization. So we'll see how that plays out in the midterms and then the next presidential election. And so I do think that there are a variety of tail risks related to geopolitics as well as internal politics. But pretty much the highest probability outcome is that this can take multiple forms, but that cash and bonds are unlikely to hold their purchasing power throughout most of this 2020s decade.
Okay, so let's say these things they just can't seem to hold their purchasing power. Is the U.S. dollar become at risk as far as being the world's reserve currency?
Well, so I do view us as shifting more and more towards kind of a multipolar system where, the United States has had this situation for most of the past 50 years where it was the only currency that could be used to buy oil in most cases. So if any country in Europe was buying oil from Saudi Arabia, if Japan was buying oil from Saudi Arabia, it was all in dollars. And what we've been seeing in the past few years is that there are countries like Russia that have been kind of shifting away from that and being willing to sell oil in euros, and that there's buyers of that oil like Europe and China that are willing to pay euros. And so we are seeing diversification both in terms of reserves as well as commodity pricing. And my base case is that that's going to continue throughout the 2020s, regardless of the strength of the dollar. So, if you look in past history, the dollar's had these two really big bear markets, one in the late part of the 80s and the one in the early 2000s. And both of those were like 40% declines in the dollar compared to other currencies, and they didn't necessarily result in losing global reserve status. So instead, I think the main thing to watch out for is this kind of shift away from a U.S. centric dollar lock on commodities and towards this more multipolar world. Now, overall, I do think I'm somewhat bearish on the dollar with a multi-year view because if you compare it to, say, the euro, if you compare it to the yen, our real rates are lower, right? So if you include inflation as well as the rates on the short end of the curve, they're lower. And in addition, the United States is, we're running larger fiscal deficits as a percentage of GDP. Our money supply is growing at a quicker rate as a percentage of GDP. And we have, kind of a trade deficit, a current account deficit compared to a lot of those other countries that have surpluses in those areas. And so overall, my base case is to probably see a weaker dollar, but that's somewhat separate from the fact that I think regardless of what the dollar does, we're going to get that spreading out in maybe a handful of major currencies able to buy energy products and other commodities.
A lot of people always ask us about things like wealth protection, stores of value, and things like that. For the rest of us, is gold and silver in physical form high up on your list of assets to protect wealth in such a time as right now?
I think it's a good idea for a lot of people. And basically, there are relatively few assets that someone can have in their own possession, bearer assets that give them some degree of insurance, against some major tail risks. And so I do think that, physical gold, physical silver, even physical platinum, I do think they can be, useful hedges in someone's net worth. And then from there, they can, if they want to use ETFs to have liquidity in some of their portfolios, maybe their Roth IRA or something like that. There are ones, funds out there that are, say, physically backed. And then also people can get into the miners or the royalty companies if they want to have that more specific type of exposure.